Either you are new to trading or you have some experience of sorts on the financial markets, but then you see these lines on many financial charts, then they confuse you or you don't even know what they are or what they stand for. My duty today is to simplify them for you from the price action perspective. So basically, support and resistance is the foundation of technical analysis. What we have here are the horizontal support and resistance level, which are the building blocks of technical analysis. So the red line is the support level and the blue line is the resistance level. This is actually a horizontal support and resistance level in a ranging market. This means that the market is not trending high or low, and this is the first thing you need to understand with horizontal support and resistance levels. The support level in basic economics is a demand zone, and the resistance level in basic economics is a supply zone. So in a demand zone, when price hits demand, you buy. Also, when price hits supply, you sell. That is, supply can be exchanged for resistance and demand can be exchanged for support. But then price doesn't trade within support and resistance zones forever. It eventually gets broken. And in this scenario, we can see that the resistance level got broken. When it gets broken, a new form of support or a new form of resistance level is formed. In a scenario like this, we have a resistance level that has turned into support. In the other scenario, we saw that the resistance got broken. Price then came back to retest the resistance as a new support level and got back up. So basically, when the resistance is broken, what traders look forward to seeing is a retracement back to the broken resistance level as a new support level. When this retracement to the former resistance level occurs, we say that a retest has occurred. Also, it is not only resistance levels that get broken, obviously. Support can also turn into a resistance level when broken. So, say in the first scenario, we saw that the support broke, then we also look to the broken support as a new resistance level. So, if price manages to retrace back to the broken support level, we can also say that a retest of the former support level as new resistance has occurred. So price then goes back down. This is the basics of breakout trading. The retracement to the broken levels may never come. That is one thing you really need to note. As much as we have horizontal support and resistance levels, we also have diagonal support and resistance levels, and these comes in the form of trend lines. In this scenario, we have an uptrend line. That is, whatever financial market you will be looking forward to trade, you will see uptrends from time to time, and be sure that some of those uptrends can be timed with trend lines. In basic trend line trading, it is a rule of thumb that you need 3 touches or more of the trend line to establish a valid trend line. So in this example, we have 1, 2, 3 touches of the trend line. The touches may be 3 or more. So on the fourth touch, you should be anticipating that the price would hold on the trend line and move back up, or the price would break the trend line and shoot down. Or whenever the breakout occurs, you can also look to trade the retest of the broken trend line as new resistance for the price to move back down. An uptrend line is always a support level. Then the opposite is true for an uptrend line as well, where we have a downtrend line. Over here as well, we have 3 or more touches of the downtrend line. A downtrend line is also a resistance level. So on this fourth touch of the downtrend line, we can anticipate that the downtrend line will hold for the sellers to keep up with their strength on whatever financial markets you are trading at a certain period in time, or the downtrend line will break up. Whenever the downtrend line breaks up, always don't forget to look for the retracement to the downtrend line as a new support level. As much as we have downtrend lines and uptrend lines, we have channels in the financial markets as well. In this scenario, we have an up or an ascending channel. An ascending channel is formed when two trend lines are able to capture the lows and the highs of a market accurately and equally. Most ascending channels break to the downside. However, sometimes an ascending channel may break the resistance of the channel. So the lows captured form the support of the channel and the highs captured form the resistance of the channel. The opposite is also true with down channels or descending channels. The highs of a down channel form the resistance of the channel, and also the lows of it form the support. Whenever you are trading a down channel or a descending channel, this market structure is likely to break to the upside. Sometimes too, the market structure will break to the downside. With every chart pattern that exists in the financial market, support and resistance makes them up. And then I presume you know about chart patterns already. So this is a symmetrical triangle chart pattern. The convergent price action over here is captured by an uptrend line and a downtrend line, which gives us this symmetrical triangle. This is the support of the triangle and this is the resistance of it. Also, we have a wedge over here, which is a rising wedge. Also, the converging wedge is captured by an uptrend line and a downtrend line as well, where we have the support of the wedge and the resistance of the wedge. Then we have a head and shoulder pattern over here. Head and shoulders pattern have necklines. With this head and shoulder pattern, the neckline right here is acting as the horizontal support level of the pattern. If you want to learn more about the simplicity of technical analysis with lines, I've left a link below which takes you in depth with a price action bias. Also there you get to learn more about chart patterns if you don't know about them already. So this was a simple introduction to technical analysis with simple plotting of lines on the charts, but that isn't all there is to technical analysis. There are a whole lot of types of other analysis which come in the form of indicator based technical analysis, Fibonacci trading, Elliott wave theory, harmonic patterns, Wolf wave theory, and many more. But what I run you through right now are the fundamentals. See you in another trading lesson video. Bulls make money, bears make money, and pigs get slaughtered.